Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to go over what an amortized loan is. So if you've ever been scared of that word, amortization, and you feel like, hey, I just want a crash course for dummies, you're in the right video because I certainly didn't know what this is. And I remember when I first took velocity banking, I was just so confused by like those amortization curves. Like, what are you talking about, right? But yeah, so we're just going to do an easy, quick explanation. So first things first, let's review the word amortization. So a lot of people sometimes they say, "Oh, amortized loan, that's scary." When all an amortized loan is just another tool in the toolbox from that the bank provides, right? So what does amortization mean? All it means is debt that's pretty much going to be eliminated by periodic payments. Okay, so if you say, "Oh, the loan is amortized in 5 years," that means you're going to have debt that's going to be paid off in 5 years, right? Oh, a 30-year amortization, that just means the debt is going to be eliminated after 30 years. That's all amortization means, right? So, can you have debt that's not eliminated by periodic payments? Absolutely. So, for example, an interest-only loan. So, I don't know if you ever taken like a hard money loan or maybe like you mean a line of credit that says, oh, interest only payments, right? That's an example of something that's not amortized. Okay, it's not going to be eliminated by periodic payments, and I'll just give you an example of this. So let's say that you took a $100,000 loan that's interest only at 10% APR. So how do you calculate what the payment is going to be? It's really simple. So let me just kind of show you right here. So let's just do $100,000. You just multiply it by 10%, 0.1, right? And then you divide by 12 if the interest is going to be calculated monthly, divide by 12, $833. So basically, after every month, right? After every month, you're going to be charged $833, right? And guess what? When you receive the statement from the lender, it's just going to say $100,000 every single time because that loan balance is not going down, right? It's not going down. Whereas maybe with the 30-year amortization loan or amortized loan, the loan balance will, chip away a little bit, little by little. But with a non-amortized loan or interest-only loan, that loan is essentially just not going to change, right? And so I think my dad actually told me, like, I don't like lines of credit because they give me a payment and the balance never goes down, and that's because um, he obviously didn't understand the tool, but it's not an amortized loan. It's not going to go down, right? There's no principal that gets chipped away, right? So okay, so basically, you might be asking like, hey, like, all right, if the balance never goes down, how does a lender get their money back? So they might have terms in the loan that there might be a 1 year balloon or something like that. So you might just make $833 payments a month for 12 months, and then you got to give me the rest of my money back, which is the $100,000 principal, right? So again, obviously, if you do get a loan that's not amortized, the bank is or the lender is going to find a way to get their money back, but not in the traditional way where you have equal payments after a certain amount of time where the loan is going to be eliminated, right? So that's all amortization means. So a 30-year loan is an amortized loan just as long as at a time period it's an amortized loan, okay? So don't get that confused, all right? So another thing I want to review is the type of interest. So a lot of people say, well, amortized 30-year loan has this type of interest or whatever. But really, when you really, there's only two types of interest, right? There's simple interest and a compound interest, and this really only refers to like savings accounts. So if you have like an annuity or a savings account, or maybe a CD, usually savings accounts and CDs are like compound interest, and then annuities, like I don't, if you don't know annuities, it's just an insurance product. I'm not going to go too much into it, but they have like several options, like simple interest and compound interest, right? So what does simple interest mean? So let's say like maybe you have a $50,000 deposit, okay? And they say, okay, well, that's a simple interest 10%, okay? So which is pretty good. But let's say they have simple interest 10%. So let's just do a quick calculation of what that would mean. So if I do $50,000, and maybe we have like a monthly crediting of the interest, so we multiply it by zero point 0.1, and then if it's monthly, that's going to be divided by 12, 416.66, right? So basically, if you have simple interest, so let's say you credited interest at month one, it's going to be $416. And then for the rest of the life of the annuity or whatever you get paid, you're just going to get $416 every single month, month two, month three, et cetera, and so on and so forth, right? That's what simple interest means. You get credited interest basically on the initial deposit or the principal, right? So that's what all it is. And then compound interest means that, so let's say that in month one you get $416 of interest, right? Month two, right? It's going to be based on $50,000 plus 416, right? That's all compound interest means, okay? So let's just do a quick calculation on that. So give me 1 second to go ahead and calculate that. So let's say 500416. Oh, did I put an extra zero? Let me redo that again. 50416. So let's say now our interest is credited at the $50,000. So we now have a little bit more than $50,000 in our account. Then what we're going to do is multiply that by 10%, 0.1 divided by 12, right? So now we're going to be credited $420 of interest. Okay, so that's basically how compound interest works. So these terms are kind of not really applicable to debts, right? So, and let me tell you why. Because when you have a debt, right, you're not going to pay the same interest every single month. Um, because what's going to happen is that the interest is always going to lower. So, and I don't want to get too complicated on this, but the difference, so when you don't pay a loan, so let's say like you pay, what's it called? You don't pay a loan, right? And then the interest accrues on top of that loan because you didn't pay it for the next month. That's essentially compound interest, okay? But if you do pay a loan every single month, it's actually simple interest. Now, I know you may think that that's kind of weird, but essentially, these terms only really apply to like savings accounts or, things that are growing your money, simple and compound. So the reason I'm talking about this is because people like try to apply these terms to debt when it doesn't really apply to debt, right? I mean, if you take a loan and you don't pay a loan for 1 month or you're late on the payments, interest is going to accrue on top of interest. Therefore, it's compound interest. Whereas if you make a payment every single month, you're just paying interest on the principal. Therefore, it's simple interest, right? And so here's some trends that you might see. So I'm going to just show you some certain things with the amortization calculator. So one of the things that really determines how much you're going to pay in interest is going to be two things: the loan term, right? So if you have a loan term right here, and also the interest rate. So if the loan term is longer, so let's say this is like a 50-year amortization, the payment will actually be lower, right? So this, you lengthen the term of the loan, the payment's going to be lower, but guess what? You pay more interest, right? So you see that this actually went lower, and then this actually goes higher. So let me actually do this. So if you're going to be a lender, so let's say, oh, I think, as a lender, I want to maximize my return. So how to maximize your return as a lender, which means, make the interest as high as possible. Number one is you lengthen the term, right? And lengthening the term will mean a lower payment, okay? And then number two is increase the interest rate, right? Now, people are more privy to this. They can see like this clearly has a effect on how much they pay, but they're not too privy to this. Like when they see this, they actually think they're saving money, right? So for example, let's say like I have a 30-year mortgage and I'm only paying $1,200 a month on that 30-year mortgage. They don't see how much interest is being paid on that because they don't see the relationship. But when they see, oh, let's increase the interest rate, and they see a higher payment, and actually let me write this down. This leads to a higher payment, right? Okay. Um, they don't see the relationship that lengthening term, even though it decreases the monthly payment, it's actually more interest. So if I were an institution like a bank, I probably want to even give out 40-year mortgages just as I'm making up in volume, right? I don't want to have low monthly payments just from one person. I want it for millions of people. And this is why I think 30-year mortgages work, because yeah, you have a low monthly payment, but if you're loaning out money to a ton of people, you're making a ton of interest, right? So let's just go back here. So I'm going to go ahead and calculate that. And so you can see here, so let's say that I have a 1 year amortization, meaning that I have to pay this $200,000 back in 1 month. This payment is going to be so sky high, but the interest is going to be low, right? So let me just go back here. So look, 17,000, and I only had to pay $6,000 back in interest, okay? And you might be thinking, wow, well, like I didn't know that was the case, because people, Americans in general, only focus on the monthly payment. They only focus on the monthly payment. But if you have a 1 year amortization, that's actually, you know, depending on if it affects your cash flow or not. If it doesn't affect your cash flow, you're good, because maybe you just needed to split it out in 12 months, but you're gonna have to pay a lot of. It's gonna eat up a lot of your cash flow for that 12 months. But look how much interest you pay, right? So to calculate, and let me actually just show you this, how an amortized loan is calculated, or the interest is calculated. It's actually really easy, okay? So the hardest part of calculating the amortized loan is the monthly payment. So amortized, let me actually write this down. So monthly payment formula, it's really complicated. This is the most complicated thing of amortized loans. So amortized loan monthly payment formula, let's look that up in Google. And as you can see here, they got some pretty intense math equations. And let's see if I can just copy and paste the image. So is this an image? All right, so let's go ahead and copy the image. And then let's get that. And I'm just going to paste it here, right? But as you can see, it's a very complicated formula. P is principal, I think R is the rate, and N is the number of payments. And then that'll tell you your monthly formula, right? And don't try to figure it out, or even memorize it. I just look it up on Google. But if you want to calculate the interest after every month, right? So the interest is just the same interest formula that we're using. It's just the principal, and let me actually calculate for you manually. So let's say we want to figure out this monthly payment interest, okay? So let me just go ahead and do that. Give me 1 second. So let's say we want to calculate the interest for the first month. All it is the principal balance. So let's say it's 200,000, okay, times 6%, 0.06, and then divided by 12, because we're going to just do it in every monthly. So you divide by 12, and you can see that this 1,000 right here, right? This 1,000 on the right is that's what we have right here, right? So that's how you calculate. It's very simple. And so the way that you know how much principal is chipped is that you get this monthly payment. So if you plug it in your formula right here, you're gonna get 1,000. Hold on, let me put this down. So $1,199 if you plug in this formula. And what you do is you calculate the interest and then pay that, and then the rest of the payment will go to the principal, right? That's just how it works. So again, it's nothing to be scared of, but just realize with interest, right, with amortized loans, the more you lengthen the term, like if you increase a 30-year mortgage to a 40-year mortgage, you lower the payment, but you increase the amount of, I'll say interest paid, not interest rate. Interest paid, right? Well, actually, yeah. No, I actually screwed up. This is for the second condition. All right, so if you lengthen the term, right, it's going to lower the payment. It's going to lower the payment, but it's actually going to increase the interest paid. So let me just kind of review one more time. So let's say we turn this 30-year mortgage into a 50-year mortgage. Take a look at this number right here, $200,000. 50, bam, right? So look at this. This is kind of like double the interest, even though the payment is lower, okay? And if I do 1 year, let's go to the exact opposite way. Look but payment increases, but the interest is so low, right? So I think that 30-year mark is like the sweet spot, okay? So where you get a nice monthly payment, but you're almost paying 112% on your loan, okay? So this is all this is just simply how an amortized loan works. So it's really not that hard. Just understand that it's a debt that's eliminated by periodic payments. So if you hear like 5-year, 10-year, 20-year term, that's an amortized loan, right? And then an example of something that's not amortized is an interest-only loan. and usually they have like a recall period after 1, 2, 7 years. You could have a combination, so they might say like, oh, you know, amortized over 7 years, but I'm sorry, advertised over 30 years, but it's actually due on year seven. You might hear that in like commercial loans, but don't think about that too much right now. Uh, I'm just giving you the simplest and easiest explanation of what an amortized loan is. Again, you don't have to fear it. Just understand how it works, right? And don't get confused on the interest. Just be aware that interest is more for savings accounts, the type of interest like simple and compound, and it doesn't really apply to debt. And the way that they calculate on a credit card, line of credit, and an amortized loan is all the same. Like there's no difference, okay? There's no difference at all. The only thing that makes an amortized loan different from a line of credit is that you're essentially not incentivized to pay more than what you call the minimum payment in a loan, right? Because if you pay more than the minimum payment or the monthly payment, like think of monthly payment as the same as like a minimum payment on a credit card, right? You could definitely overpay it. It's going to have the same effect, but with a loan in general, you can't ever pull back money that you overpaid, right? That's just how loans work, one way street. All right, so this is Korean Atlanta Mentorship. Hope that was helpful. If you're interested in joining our group, go ahead and click the Google form link below. Other than that, have a great day and cheers.